Okay. Well, as expected, the economic data released today reflects the impact that global uncertainty and volatility has had on New Zealand workers and businesses. The Stats NZ figures released today show that having increased 0.9% in the first 3 months of the year, GDP has now fallen back 0.9% in the second quarter of the year. International turmoil and uncertainty relating to tariffs clearly had a significant impact on firms and households' willingness to make investment decisions. Economists will have a range of views. My view is that the Trump tariff announcement had an outsized effect on the New Zealand psyche and people's willingness to take the risk of greater investment. The second quarter of the year, which is what relates to the data we're discussing today, started the day before United States tariffs were announced, and it does seem to have had a chilling effect here at home. The economy had been growing strongly in the previous 6 months, but suddenly had the stuffing knocked out of it. And I feel for all those people and businesses who have been affected, and I think this data reflects sentiment that was already widely understood on the ground. It is important to remember that this is backwards-looking data. We are now nearing the end of the third quarter, and there are signs that the economy is now growing again. People have recovered from the sentiment impact of the Trump tariffs to some extent. In addition, lower interest rates are filtering through the economy. There is evidence of increased mortgage lending. Around half of mortgages are set to refix on lower rates in the next 6 months. And the outlook for most export sectors remains positive. All forecasters that I've seen are expecting economic growth to strengthen from now on as the uncertainty about the impact of tariffs eases. There is no doubt that the second quarter of this year was a difficult period for the New Zealand economy, that we have the conditions now for future growth, and that is what our government is working hard every day to support. I'll take your questions.
How can you blame international headwinds when Australia's economy grew 0.6%?
Yes, well, it is the case that some other economies contracted in the second quarter. Germany, Canada, Finland are examples. However, it seems to me that the Trump tariff announcement did have an outsized impact on New Zealanders' willingness to invest and grow after a period of difficult recovery. 1 in 4 jobs in New Zealand depend on exports. We're a small, isolated country at the bottom of the world. When the world sneezes, we feel it hard, and I think the sense of uncertainty about what the Trump tariff regime would mean, not only for our exporters to the US, but for our exporters to China and other countries around the world, was felt very keenly. We were just coming into recovery. We'd had 6 months of growth, and I think people were remaining cautious, and this gave them a real reason to step back and stop taking risks. The opportunity now that we have more certainty and clarity about where the tariff regime is for people to dust off those investment plans and start growing again.
But so that's going to cause you to change any of your economic policy, economic strategy going forward?
Well, what I'd note is that government expenditure isn't a factor here. In fact, our government expenditure was mildly stimulatory last year, and what you can see in the data today, in particular, I'll take you through some of it, is that government expenditure is up year on year, and particularly in a number of categories. Overall, we are borrowing right now as a government to support investment in the New Zealand economy.
No fiscal stimulus in light of this?
Well, we are already stimulating the economy by definition because we are borrowing billions in order to keep investing in the infrastructure we think is essential for growth, to continue investing in a range of government services. We are seeing some positive signs in our economy. The current account deficit has shifted, but we can't be complacent and think that New Zealand can just keep borrowing more and more and more. We do borrow a lot of money from the world. They don't owe us a living, and it's important that the government is responsible to keep the interest rates on that low.
One of the big declines in construction, though, and that is where the government has cut back.
Yeah, that of course, though, in the previous quarter had grown. So while we've seen that growth now cancelled out by what happened in the second 3 months, it's clear that the government is making a contribution to future construction growth. We have $7 billion worth of projects already kicked off or will be underway before Christmas. The fast-track regime significantly means that private investments and major housing developments, quarries, ports will be able to happen a lot faster than would otherwise have been the case. In the case of Auckland Port, that is a project that is thought would have taken 5 years to consent. It took 5 months. Spades will be in the ground before Christmas. So the government absolutely has a role to support construction activity. We do that through our investment in public infrastructure and ensuring that money's getting out the door, and we do that to support firms to make their own investments.
You began your statement with as expected, but this is much worse than was expected, 3 times as bad as what the Reserve Bank was forecasting. What has gone wrong?
Well, look, a decline was widely expected, but you are right, the drop-off is greater than consensus forecasts. I'm sure the Reserve Bank will take note of this because, of course, they have underestimated the decline that was occurring in the economy. They estimated that the decline would be 0.3. We now know it was 0.9. I think that affirms their decision in August to pivot to a lower interest rate track than they had previously predicted. I note that the market is now pricing in potentially an even lower interest rate track. I'll leave the Reserve Bank to make those decisions and comment on them, but I note that their next opportunity is on the 8th of October. It is the case that the Reserve Bank has the largest levers here for ensuring economic recovery in terms of providing confidence that interest rates will remain low and borrowing will be more affordable.
Given the tariffs went up in August, do you expect fiscal in the quarter to be worse or at least still declining?
Well, there's now certainty, and I think that's a big factor, is that uncertainty is often more chilling than certainty. What we've seen in terms of exports to the US specifically is there seemed to be a surge ahead of the tariffs coming on, then a slump when they came on, and now there's some evidence of a bounce back. In July, there was a 7.8% increase on exports to the US compared with the same month in 2024, which is certainly encouraging. Across the board, across that same period, non-US exports grew 10.8%. So what we are seeing is export growth is continuing, and I think that now that people understand what that US market looks like for them, they're able to make investment decisions and have a plan for their exports.
So in your mind, is it essentially all in the sentiment rather than the tariffs themselves?
I believe that there was a very big impact to the New Zealand psyche when the US tariffs were announced. People saw massive uncertainty, huge market volatility globally, a significant range of scenarios for how bad the downside implications could be for our small, isolated trading nation. And having just come through 6 months of recovery, many firms said, this isn't the time to dust off my investment plans. This isn't the time to expand my workforce. Let me wait and see. And once I know what the ground looks like, then I can make my growth plans. And certainly, as I said, that is what the data tends to back up, that we saw investment slumped in that second 3 months of the year. There's now signs that it's returning. It's positive, of course, that retail spending is up and it's above what was being forecast. That suggests that consumers are starting to feel the impact of lower interest rates in particular.
At the start of the period of uncertainty with tariffs, you suggested that you were staying the course.
Mm-hmm.
Is that still your view, even though staying the course, has, I've worked past judgment on whether it's the wrong or the right idea, but that has seen the economy decline?
Well, we thought it was very important that in a time of uncertainty globally, factors outside our control, that the government provides certainty. And our certainty is important for a couple of reasons. First, because we know that lower interest rates are needed to stimulate economic recovery. If the government sends uncertain signals about its fiscal intentions, that can lead to a hold-off on interest rate reductions, which we believe would have been very harmful for the New Zealand economy. We also think it's important that New Zealanders understand that while, of course, the US tariff rates are a setback, we should still have confidence in the overall picture ahead of us, which is wide global demand for the products and services that we produce, a stable base of stable inflation, of stable interest rates, and a government that is firmly on the side of business investment and growth. And that is demonstrated by our actions, whether that's the investment boost tax policy, which gives a clear nudge to businesses that investment will be rewarded through our tax system, whether that's our steps across the board to reduce the regulatory burden, not least in that building consent and resource consent area, which is essential to speeding up construction across our economy. Our openness to overseas investment and trade, and our willingness to build on the constellation of trading relationships we have around the world, our focus on the government's role in directing research, science and technology, and our critical role in not only planning infrastructure, but delivering it efficiently and at pace. Those are still the right things to be doing.
So you're still of the view that fiscal policy should remain quite stable through different points of the economic cycle, and monetary policy should be used to smooth the edges?
Well, monetary policy plays the most important role at this point in the cycle. It's also the case, however, and I just highlight this because, frankly, it doesn't come through in your reporting. The government is borrowing at very high levels right now. We are running an annualised deficit bigger than many countries we compare ourselves with around the world, and that is consciously. We are choosing as a government to invest more in infrastructure and spend more on government services than we are making up for in terms of the tax we take from New Zealanders. And the reason we're doing that is that we think that that is necessary to not only support economic activity right now, but to drive future growth. We think it would be the wrong thing to do to suddenly get rid of that deficit and have a situation where services to New Zealanders were reduced or where investment in infrastructure had to be curtailed. At each of our budgets, we have added more spending to infrastructure, more spending for health, more spending for education, and that is despite having been left with a mountain of debt.
Do you believe that New Zealand is heading towards slipping back into recession?
For that to occur, that we would have to see negative growth in the second quarter of this year. That's the period we're in right now. The consensus from forecasters is that is unlikely to be the case.
Are you getting any advice on what this means for your fiscal targets? Because I guess just independently of anything else, lower GDP, lower than expected GDP makes that debt to GDP ratio figure look worse. Is that a concern?
Well, in terms of the fiscals, it's the nominal numbers that matter most, and those are holding up. And of course, I'll get updates on what the fiscal track looks like at the half-year update and also at the end-of-year financial statements. I don't have reason to believe at this stage that this puts our fiscal track off.
Have you spoken to the Prime Minister about, since you became the Economic Growth Minister, there has not been economic growth, substantial economic growth?
Well, there was in the first 3 months of my tenure, Thomas, at 0.8%. It was much faster growth than there was in Australia. It's true, Trump disrupted my momentum.
Okay, but have you spoken to the Prime Minister at all about his continued confidence in your ability to hold that portfolio and grow the economy?
Yes, and the Prime Minister has confidence in me. We are doing the right things, and I would say clearly we believe that our agenda responds to what those who are making decisions about investing and hiring people have told us matters to them. They've said, if you want us to grow our businesses, we need confidence about the tax settings. Please don't hit us with more tax. That's why we did Investment Boost. They've said to us, please get rid of some of the red tape that stands in our way when we want to grow. They've said, please improve your government procurement policies so we can win more contracts. We're doing that. They've said to us, make sure your trade settings and your investment settings are right. Make sure you're getting infrastructure projects out the door. So when I look at our Growing for Growth agenda and the work programs that ministers are progressing, I think they correspond strongly what businesses and investors have told us is necessary to move New Zealand onto a higher growth track in future. There is no doubt we have been through a very difficult economic recovery. I retain complete confidence we will come out the other side stronger and better.
You campaigned on, so the Prime Minister said Grant Robertson was the worst finance minister New Zealand's ever had. You've come in, you've delivered. This print is quite bad, objectively quite bad. Unemployment's quite high. Immigration, which is flattering that unemployment, is also quite high. Are you regretting the not being able to live up to the stark contrast that you painted between yourself and the former government? Well,
I look in the period ahead of me and I know that we will make progress, and I'm also conscious that things would be a lot worse if our government hadn't been elected, and I am very confident that we have taken the right steps to strengthen this economy for now and for the future. back on track looks like a growing economy with fewer people looking for work. It looks like more businesses choosing to invest and expand.
You're not back on track with that definition.
Well, as I said, during the first 3 months of the year, the signs were looking very positive. It's always been the case, I'd remind everyone again. Prior to the election, when Grant Robertson put his forecasts on the table, he was forecasting that unemployment would be peaking at this point. In fact, what the Treasury data shows us is that the number of unemployed New Zealanders is now lower than Grant Robertson was forecasting. The point that I'm making to you is that no one ever denied that we would go through a cyclical downturn and that recovery would be hard-fought. That has proved the case. We didn't campaign on knowledge of Trump's tariff announcement in April. It is to be expected that global events outside our control will occur. What we are responsible for is taking the policy actions we campaigned on and ensuring that we are controlling and taking responsibility for the things that lie within our power, and I believe our record shows that.
You didn't accept the previous government pointing to international factors when you were in opposition, so why should the Republic now accept?
Well, the clear argument I had with the previous finance minister, and which I stand by, was that he said that outsized inflation was simply the result of international factors. What the data showed was that he was spending at very stimulatory rates while we were also importing some inflation. And my point was, this is the time for you to be holding back, not hitting the accelerator. He made it much harder for the Reserve Bank by spending at very elevated levels when it was trying to get inflation under control. So I do stand by my analysis that the last finance minister did the wrong things at the wrong time. And partly that is why this recovery is more challenging than it might otherwise have been, because the last government chose to spend so excessively at the wrong point in the cycle that it has made our economic cycle more volatile and more difficult than it has been in some other countries.
On the uncertainty point, you were saying we've got certainty now about the tariffs, but Donald Trump's still at the White House. There's an election in New Zealand next year, which on current polling you'll lose. Can you really tell people to invest now because things are certain now?
Well, on the latter point, the most important thing for certainty is not to elect an alternative government whose proposal is to tax more, borrow more, and make things harder for business. I think New Zealanders want to see this as a recovering, stronger economy. The last thing we should be doing is scaring off the talent, the capital, the entrepreneurs we need to drive that recovery. If we want more rocket labs, more zeros, more successful world-leading food producers, what we shouldn't do is threaten them with more taxes, fiscal instability, poor economic management. What we need to do is stay the course with sensible economic management that sets the foundation for growth.
On the substance of my question, though, is the uncertainty really over? If that's the picture right now. Donald Trump's in the White House and the midterms aren't until November. Has there been an election in New Zealand by then?
Well, I think you are right to point out that a degree of global uncertainty will persist, and you are seeing international forecasters downgrading their assumptions of international growth over the coming months. But things are a lot more certain now than they were when Trump first announced his tariffs. You'll recall back in April there was talk of an ongoing escalating trade war between China and the US. There was talk of tariff rates as high as 50% for many countries around the world. A lot of that has not transpired, and in New Zealand's case, we have been given certainty that our exporters face a tariff rate of 15%. While unwelcome, they now know what that is, and they can make decisions about how to work with that.
But just back to Zane's first question, what is it about Australia that they're able to get GDP growth of 0.6%, but ours has shrunk by 0.9%? What is Australia doing right that we're doing wrong?
Well, in the first quarter of this year, we grew much faster than Australia. So you're just taking one quarter and comparing our growth rate there. I'd also point you to the first quarter of the year.
Minister, which you have directly said is the result of the decline in this quarter, so I'm only comparing those two.
Yeah, well, look, I think that's a fair question, and as I said at the beginning, my sense is that the tariff announcement had an outsized impact on New Zealand sentiment. It appears to me that Australian firms and households retained higher levels of confidence through that period than ours did. And the data backs me up. You saw a big sentiment shift happen after Liberation Day in New Zealand, with business and household confidence taking a dramatic slump. I think I'd also reflect that New Zealanders had been through a particularly difficult recovery. Many of them, as we'd seen in the previous 6 months, were beginning to grow and beginning to move forward positively, but it was a big blow at a time when they were only just recovering.
In your answer to Russell's question, if you had more fiscal space, if you were bequeathed more fiscal space by the previous government, would you, looking at these numbers today, be acting differently?
Well, it's simply the fact that right now one of the biggest items of government expenditure is the interest bill we're paying on Grant Robertson's debt. It's currently $9.5 billion a year. To put that in context, that's enough to pay for 4 transmission gullies. That's enough to pay for the entire Defence Force budget. So it is the case that if debt were lower, then obviously that interest bill would be lower.
And if the debt were lower, if the deficit was smaller, and this GDP landed on your desk today, how would you act?
Well, I still think that our fiscal path is the right one, which we have said this is not a time for drastic action, but we do need to consolidate our finances. We have forecast a track that gets us back to surplus in the 28-29 year. That's some time away because we want to do this gradually and carefully. But I remain of the conviction, and I believe New Zealanders share this view with me, which is this can't be a country that borrows in perpetuity. We need to have the reserves for a rainy day so that, God forbid, if there is another large earthquake, there is a biosecurity incursion, there is another pandemic, then we can afford to borrow from the world to keep our services going. And as it is, our debt is the highest it has been in many, many years. It is forecast to keep growing, and any finance minister sitting in my chair has a responsibility to get those books back in balance.
In terms of the outsized response to the tariffs, I mean, isn't it part of your job to kind of manage those expectations from the markets?
Well, I'm not responsible for the individual business decisions that firms make, and I philosophically believe that businesses have to make the decisions they think are in their best interests. I can encourage them to invest, but ultimately I can understand why, if you are, for example, a manufacturer and you're looking at a world in which you don't know what's happening with tariffs, what tariff rate you'll face, you might at that point choose this isn't the time to be expanding. But they now can see clearly there's a lower interest rate track. We know what the tariff regime looks like. Certainly what we're hearing from exporters who are affected by that US tariff rate is that they do feel they can accommodate it in a range of ways, and that they can continue to grow their exports into that market.
Do you think the Prime Minister gives New Zealanders confidence about the country's economic management?
Yes, I do, because all you have to do is look at the alternative. Chris Hipkins couldn't even tell you how much we were spending servicing our debt. Chris Hipkins has reached for one of two things every time he's asked for an economic policy. The first is he says borrow more. The second is he says spend more. New Zealanders experienced that for 6 years. And actually, if that was some magic recipe for a stronger economy, then why did we have some of the highest inflation we've had in a generation, interest rates soaring, huge negative effects across our economy? New Zealanders saw the debt that was accumulated, that almost doubled as a proportion of GDP, around $100 billion worth of debt. And they asked themselves, well, what do we have to show for that? Because there was certainly no Auckland Light Rail at the end of it. There were no major infrastructure projects. There had been no transformational change. A lot of that money, unfortunately, was frittered away. That is the habit of Labour-led governments. We are a government that says, actually, we will invest in the things that matter to you, school services, health services, more police on our streets. But equally, we need to treat your money with respect, because if we just keep borrowing and frittering away, it's your kids and grandkids that will pay the highest price, and overall our economy will be less stable, more fragile, weaker in the years to come.
Is reducing debt to GDP as high up on your priority list as it was, say, a year and a half ago?
Well, I do think it's important that New Zealand have a buffer so that should the worst happen, we're in a position where we can confidently borrow from global markets.
So, when you first came in, that was a big priority, getting it to below 40%, and of course it's due to keep rising before dropping off. Is that still a goal? Like, I know you have to trade off so many different factors, you want to grow the economy, all these things, but how high up on your priority list is that debt to GDP reduction? Well,
as I've said before, the key thing is actually getting our spending and our borrowing in order on an annual basis, which we do by getting back to surplus. The reason back to surplus matters is that it indicates that we've got ourselves onto an even keel where we're not spending more than we earn. And that, of course, is the prerequisite for debt reduction. The other critical factor that we remain focused on is economies are better placed to manage their debt, to invest in public services and public infrastructure when they grow faster. Because the simple fact is, when businesses are doing better, the government collects more revenue and is better able to invest that in the things that New Zealanders care about. So that commitment to getting balanced books, to getting a growing economy is as strong as it ever was.
Isn't part of the problem though, like if we're talking about growth and we look at construction, for example, I've heard that part of the problem is that demand for residential properties has dropped because there isn't as much growth in population. So how do you fix that problem?
Well, in terms of that population factor, there's some evidence that the migration levels are now levelling off, and we would expect to see more recovery. And certainly the government has taken steps to ensure that whether it's investor migrants, business migrants, highly skilled migrants, that we have the right settings to attract them. It's also the case that the housing market pretty closely follows interest rates, and we know that as interest rates drop, New Zealanders become more confident about borrowing for a mortgage, and the data is starting to show that. They become more confident about buying a larger house or entering the housing market for the first time. We have the greatest proportion of first home buyers in the market than we've had in several years, and that tells me that confidence in that housing market will recover. Treasury continue to forecast moderate house price growth in the years ahead, and I haven't had any data to suggest that won't be the case.
Just finally, the Reserve Bank nearly got it wrong in July with their quarter cause. The fact that call was so wrong, will that impact on your decision making
It will not impact on that decision making, no.
Are there any particular sectors you can point to that you think overreacted specifically to the Trump tariff?
Well, look, just overall the data shows that there was a significant drop-off in investment. Now, investment is a discretionary choice for any business, no matter what sector it's in, whether you're in manufacturing, whether you're in transport, whether you're in mining. Choosing to buy the next piece of equipment, build the next building, is a decision you make when you're confident about the future. And I think that people took a pause. There is evidence that they took that pause, took a deep breath, have dusted off their plans and started getting investing again, and that's what we want to see.
The Prime Minister at the start of the year gave a speech talking about, this year being the year of growth, going for growth. How do you think that's panning out?
Well, I think we mustn't forget that in the first 3 months of the year we grew around twice the rate that Treasury had forecast, many times faster than Australia did. There's no getting away from the fact that we've had a very difficult 3 months. But I don't think anyone should pretend that was unexpected. We've been experiencing that. We are talking today about the period from March through to July, and I think many New Zealanders could have already told you that was a difficult period for the economy. The question isn't, was it difficult? The question is, what do we do to ensure that we grow faster in future? And I look at the activity our ministers are doing across the board, and we are, wherever possible, cutting red tape, speeding things up, ensuring we're investing in the things that support growth. We need to continue doing that. This is not the time to change course.